in Southeast Asia for HSBC. He is the CIO, Southeast Asia, for HSBC Global Private Banking and Wealth, representing the Association of Banks in Singapore. Please welcome Mr. James Cheo.
Well, thank you everyone for having me here. So it's great to speak to all of you here. So how many of you are from NUS? Oh, NUS. NTU? Wow, that's like majority. SMU? And the rest? Any more? Oh, the rest. And the rest. Okay, I am also from the rest in a way. All right, I think today what I want to cover, it's about portfolio construction. But before I go into that, maybe share with you kind of a story. When I started my career about 20 years ago, what I had was actually 4 screens on in my office. Basically, markets, Bloomberg data to show what happened the day before, and then I will kind of make kind of an assessment of what's going to happen the next for that trading day. So that 4 screens worked very well until 2016. Why is that so? The election of President Donald Trump. Because that 4 screens don't work. I need to take out my phone to check Twitter, because what he says moves the market. So I had to adapt at the time. And then subsequently, of course, when President Joe Biden got elected, he doesn't say stuff that badly. So I don't need that Twitter screen. But I have to follow someone else. Anyone? Any guess? Yes, Elon Musk, right? I have to follow him. So I have to follow what Elon Musk say. And the thing about financial markets is always that you want to be a little bit smarter. Not too smart, but one step ahead. So I asked my friend, who is an analyst covering Tesla. So he knows Elon Musk inside out. So I asked him, how do I follow Elon Musk? How do I get to know him better as an analyst? And he told me, you don't just follow Elon Musk on the social media. Follow his girlfriend. Wow. Then I say, which girlfriend? Always change, right? So recently I asked ChatGPT, who is Elon Musk's girlfriend? Oh, ChatGPT also cannot give me the answer. Anyway, I think that this story shows that in terms of investing, it's very important, right, to kind of adapt, because the environment changes very, very fast. And what's important and what never change are principles that will guide you through. And today I want to share with you one quote on how you should start your investment journey and why you should start it as early as you can. It's because of this. You all know this guy, right? One of the smartest people ever lived on earth, Albert Einstein. He says investing is really about the power of compounding. Essentially, you allow the compounding interest to let your money grow. And that's one of the most powerful force why you should start your investment early. But of course, the big question is how you're going to construct this investment portfolio. And we all know that in terms of investment, it's always a trade-off. It's always about returns, but also at the same time about risk. The higher risk you have, the higher returns. But the trick is always to take calculated risk. So whenever you see something that perhaps is too good to be true, something that promises you 30, 40% in a few days, is probably not true, or probably extremely risky, because it also means you can lose that amount almost immediately. So you always have to bear that in mind. Always have a frame of mind that investment returns have to be compensated by risk. And that's very important. And also there's this thing about psychology that you all have to know yourself. And there's this concept in terms of psychology called loss aversion. It also means that at every dollar you gain, what it means is that every dollar you lose costs you more psychologically than every dollar you gain. You get what I mean? So when you lose money, the $1 you lose in terms of your investment is very painful compared to the happiness that you get from the $1 gain. Have anyone started investing before? Raise your hands. Investing, whether it's crypto, whether it's stock market. So very few. Only 1 or 2, 3 or 4 people. So when you start your investing, if you buy into something, for example, and my advice to people is this: if you can't sleep when it comes to your investing, because when you start really investing, right, the first thing you wake up, right, is to check what's the price of the investment, because you're worried whether it goes up or down, then probably that amount that you invested is probably too much. You want to be able to sleep properly at night, right? So I think it's very important to kind of have a solid plan. If you invest in something that's too big, too risky, and you get worried every night, then probably either your strategy is wrong or probably the amount that you invest is probably too much. So this is something to bear in mind, loss aversion. And with all these psychological traits in us, we are all humans, these things kind of impede us from making the best decision. And I think this is something to kind of know ourselves, that all of us have this feature. And another very important factor that every one of you all have to consider is this, is that you might actually live longer than you think. And that's good news, right? Most likely than not, you have to make your financial plans that you live to 100 years old. If you pass that, it's good. If you're near that, okay, it's fine, right? But because you are very young, so your runway is extremely long. But even for someone, let's say at 65 years old, if you plan to say 100 years old, that's 35 years. 35 years is probably, one business cycle is 7 years. So you have 5 business cycles, which is actually a very long time. So even when a retiree at 65 years old can't just say that I'll take all my savings and cash it and spend everything. You can't. Even a retiree at 65 still has to invest, still have to think about investments for the next 35 years. So that's how you should frame it. And of course, the earlier you start, in your 20s, if you start, the better it is, because you can have the power of compounding. And that's the most important principle. And I'm going to show you how some broad ideas and principles, how you can construct a portfolio that could be resilient and could help you build over time. So there are actually 3 principles of wealth creation. I think the first, there are a few things you can do. You pick the right companies, pick the right stocks. Stock selection, that's number 1. The second, market timing. Basically, you buy the market at a low, sell it at a high. Second feature. And the third is asset allocation. That means how much I put into equities, how much I put into bonds, how much I put into commodities. So these are 3 levers that you could do. And you can build your financial wealth over, there's only 3 ways, or a combination of these 3. But having been in the financial industry for 20 plus years, people who succeed in 1 and 2, very rare. Most people don't. And even professionals seldom do it very right on 1 or 2. But number 3, asset allocation, is something that everyone can do. And that's why I want to spend a bit more time on that, because it's important. Because this is something that all of you, if you put your heart to it, you can do it. But 1 and 2, hard to say. It takes a lot of research. Sometimes it takes luck. Sometimes it takes a lot of skill. So it's very difficult for that. To do it consistently, you can be lucky 1 or 2 times, but doesn't mean you can be consistent every time in and out. So the thing about security selection is this. If you start buying a particular stock, you will realize that if the company is actually extremely volatile, it can move significantly in a day, 5%, 10%. And over the course of 10, 15 years, companies that previously was the darling of every investor can become something that becomes obsolete. So these things happen. If you all can guess which company this is, I think I can treat you all to coffee or Netflix. Netflix didn't exist in 1993. Any guess? Citibank? No, not Citibank. Any guess? It's very hard to guess. Huh? Nokia. What? Nokia. Yes, Nokia. Correct. But clap. Any of y'all use a Nokia phone before? Too young. But when I was your age, Nokia phone was the phone, and everyone was buying it. It was cool. It was cool at that time. And of course, at that time, the price, right? Because it's almost like going up and up and up. So that it was the darling at that time. But as with all companies, some companies may not adapt and make changes. Well, Nokia did not adapt, did not change into adopting smartphone as fast as Apple did. And of course, along the years, it lose market share. So if, let's say, someone who have bought it at 60, for example, it's worth nothing now, almost. So that's why security selection, it may work for some people, but it may not work for everyone. And of course, market timing is extremely also a lesson that's very important. The thing about building portfolios, you want to pick markets that would typically rise and increase over time. What I'm showing you, I think the red line is the US market. The black line is China stock market. And what you can see, the difference is that the US stock market typically goes higher over time. From time to time, the US market will experience pullbacks, but generally the trend is up. And when it comes to constructing portfolios, you want to add these sort of markets into the portfolio, rather than markets that are extremely volatile, and over time it's actually like, it doesn't move, it doesn't change much. China is one example. China's market, yes, you can make a lot of money at certain points of time. There are bulls, bear, boom, bust. But over a long period of time, it's still roughly the same place, let's say over 10 years. And in fact, over 10 years, maybe it's a bit down at different points. And it requires you to pick at the right time, sell at the right time. And it's quite difficult to do that. You want to construct portfolios into markets that have a certain consistency that goes up. There are a few reasons of all these differences, but I'll leave that differences for another time. And I'm happy to kind of talk more about it, why the US market typically outperforms. But what's very important today is not to say which stock to buy, which markets to invest, but really to kind of think of it as a whole, of how you can start constructing portfolios through a systematic asset allocation strategy. And I think there's no one-size-fits-all for everyone. It depends on how much risk appetite you have. It depends on what's your objective at the end of the day, what you want to achieve in life. And ultimately, of course, the principle is this: if you're younger, you can afford to put more into equity market because you can take a little bit more volatility. But as you grow older, you want to build more income into your portfolio. So you will have greater allocation to income-bearing assets such as bonds. So you can achieve a certain kind of a cash flow that you want when you grow older. So principally, that's how you should do it. But there's no one-size-fits-all for everyone. And there are a few ways to build a diversified portfolio. In fact, there are four ways. Number one, of course, I'll go through it, is diversification, long-term focus, optimization, as well as rebalancing. Some of these terms are a bit technical, but I'll quickly just give you a broad overview of it. And the first thing is diversify. This whole chart shows something. What I did with this chart is that it's over the course of the last 10 years or so. And every year, I try to rank from the top performing asset class, and then I rank, so top and then to the last. And I do it for every year. And what you can see is this, there's no pattern. One year, the one that does the best, the next year, not necessarily the same. And that ranking always changes. And when you diversify, what you're saying is that, in fact, you're just saying that I don't know. I don't know which asset class is doing well. I'm just putting equal amounts of money into each of the asset class. And if you've done certain research, there are certain strategies. If you are in this industry long enough, there are certain kind of strategies involved. There are people who chase after momentum. So people who chase after momentum typically says, if this year this asset class is the best, next year this asset class will do well again. So they chase after the winners. So this is one strategy that people do. There's another strategy that people do, which it sounds smart, it's contrarian. That means this year, this asset class did very well, next year it's going to underperform. Or this year, the worst asset class, next year, since it's cheap, I'll buy it, it should do well. So that's the contrarian. So that is a strategy. And there is, of course, the one that it sounds stupid, which is actually I don't know, but I just put everything the same. And if I were to kind of compute these three strategies, that means someone who does momentum trading, and I would just buy the winners every year, versus a contrarian strategy, that means I buy the losers every year, or versus someone who's very systematic to just diversify and put equal weights on all the asset class. and I pull through 10 years, interestingly, the winner is actually the one who diversify, not the one who chase after the markets, not the contrarian. On a 1 to 2 years basis, things can change. But if you want to look for consistency, someone who diversifies equally actually is the one that outperforms. So this is something very important, to just say, I don't really know what's going to happen. I should just diversify. And the principle behind diversification is actually this. It's actually finding asset classes that are kind of negatively correlated with each other, which means that if the stock market goes up, and if the bond market goes down while the stock market goes up, I want to put these two assets together because it does give a certain diversification benefit. And the principle is this, because every investment, every asset class investment, it's just a risk and a reward. There's a certain reward to it, there's a certain risk. And you can plot all these dots all over this chart, where one axis is the returns, the other axis is the risk. And you can find that in order to sort of optimize a certain portfolio, I want to combine it with the right formula such that I get the highest return for a given risk. And that is what the whole optimization process is. In fact, if you are interested, you can actually calculate, if you have the historical data of various asset classes, you can calculate the right mix. I think, how many of you are in year 3 or year 4? Finance? Have you all done portfolio optimization? Okay, you have done Markovich, right? Okay, if you've done that, you actually have to calculate that weights of how you optimize portfolio. So you can do it on Excel even. So this is the first, like a very rudimentary way of doing it, but hardly anyone does it. And I think it's very important to think of investments through that lens, because you want to optimize and get the right mix. So this is what optimization of portfolio is all about, to find different asset class with different correlation and get the right mix. And of course, one of the main reasons you want to optimize and have a global diversification is to open up the opportunity set. Because you want to say that I don't know one asset class very well, but I want to include everything in this world and find something that has the best mix. And I mean, the fact of the matter is that if you interview or you speak to anyone on the street, most people have a certain bias when it comes to investment. That has to do with psychology, has to do with background. Most people on the streets in Singapore would when they talk about investing, they'll just buy into Singapore stocks, Singapore shares, because these are things they know. They'll buy Singapore Airlines because they know of it. They'll buy Singapore banks because they know of it. But if you think of it from the whole scheme of things, there are actually better investment opportunities outside of Singapore, for example. And you can get a better risk reward if you combine it with other asset class from the United States, from other parts of Asia. And I think that's what most people fail to kind of see, is that they are very much focused on their own home currency. And another very important feature is that once you manage to build that portfolio mix that suits you, you want to hold it over the long period of time. You don't want to kind of sell it too quickly because of the fear of loss. Because even when you build that sort of diversified portfolio, it doesn't mean that you won't lose money from time to time. You just have to hang in there and let it continue right up. And this chart shows the difference between just holding the portfolio on its own and let it ride up versus missing out the 10 best days. Because usually the 10 best days are the most, like within the 10 best days, it captures the bulk of the return. So the red line will be that if you sell off and you take away the 10 best days, and you can see a huge divergence in performance over the course of 10 years. In fact, if you held a diversified, if you just held a global equity indices for over the long haul, over the last 20 years, you would have gotten about $1, you have gotten about $2.5. But if you sold it off and you take out the best 10 days, you're pretty much just a little bit flat, or just a little bit above 100%, a dollar that you put in. So it's a huge difference if you take out just the 10 best days when it comes to investing. And I think what's important, of course, is sticking to a plan, and also from time to time, the initial allocation that you set, that's good, but you have to rebalance from time to time. So I'll give you a very simple example. If you start off with a portfolio that's half, for example, half equities, half bonds, That's the start. But because of price movements, that allocation will change. It will not be 50-50 by the end of the year. It would have changed. Perhaps if the equity market gone up, your allocation to equities will probably become 60 to 60-40, right? So because the value of equities increase. So what you do during periods of rebalancing is that you shift back to 50-50, for example. And when you shift the allocation, you're essentially kind of locking in the profits. Because if equity market's gone up, your allocation of equities has increased, but you bring it back to 50, which means you sell equities and you buy bonds. So by doing that rebalancing regularly, you're able to lock in your profits and perhaps buy low for certain assets. So this is something that's important to put in place once you build your asset allocation strategy. And I talk about optimization. That's something about how you get the actual weights when it comes to investing. So I think putting all together, essentially this is, to summarize, is really about the 4 principles of diversification. You first have to diversify. You have to optimize your portfolio, keep a long-term view, take away the emotions that you all might have, and ultimately, from time to time, you want to rebalance your portfolio to kind of make it relevant. So with that, I will pause here, and I think I'll be happy to take questions. I'll hand the time back to the host. Thank you very much, everyone.
Thank you very much, James. So, any questions for James right now? We've got a couple minutes. Yes.
Thank you. Hi guys, I'm from SUM. I have a question because several years ago I invested a bond, but turns out it didn't went well. It's always losing money fluctually. So it's may not about our theme today, but I would like to ask you how I handle all the things. So do I sell it out to cast last or just hang there and wait it?
Yeah, oh no, great question. If you held it for 7 years, I think you held it perhaps too long. Because 3 years, because it's also, I've talked about loss aversion. Once you lose in a certain position, the reluctance to cut loss is always very painful. My benchmark is this: if any investments, if it had dropped 50%, for example, it's probably gone. Because you need it to double to get back to where you are. So when it's down 50%, it's almost like in a soccer match, halftime 5-0 down. That's gone already. To me, 15% is always the limit. Because if I'm down 15%, I'm still within, there's still a chance to recover. So I would put certain loss limits. Yeah. And if you don't have any loss limits, if it goes to 50, tendency, I've seen many investors, they hold on to it, and it just goes lower and lower, and the recovery is very, very difficult. But ultimately, what I would say is this: some positions is lost, but it's never too late to kind of start a diversified plan, because typically, usually these losses are sporadic stocks that you buy and doesn't fit a total strategy. I think it's very important to kind of start, it's not too late to start thinking about it in how I explain, to kind of build your wealth over time through a diversified portfolio. Thank you. Thanks for the question.
Thank you. We got time for a couple more questions. Was there? Here you go.
Hi, I'm Michael from SUSS. When you talk about diversification, is it the objective is to achieve a hedging effect, that you do not risk all your asset? So if you have a hedging strategy, how do you know that the strategy is going to work? Because all assets are going to be affected in some kind of crisis. So your diversification didn't reduce your risk to the crisis.
Well, Mike, thanks for that question. I would say that diversification is not to help you get rich, but it's to help you grow your wealth over time. I mean, if you think of it, if you can have around 7, 8, 9% every year, and you let that compound, you can build your wealth easily you can double your wealth in less than a decade. And that's what you want to do, to let it kind of grow and let the power of computing does its work. Through asset allocation, through putting some in equity, some in bonds, some in alternatives, it's typically not possible to get 2 times return in a year. Not possible. You're actually just trying to secure high single digits. Is that a hedge? I don't think it's a hedge. But when a crisis comes, and there will be crises, I've seen many crises, typically you're right, everything falls down together. But if I hold it in a diversified portfolio, that risk is limited. That drop won't be that much. And you should stay invested during that time and let it recover. But for instance, if in contrast, if I held on to a particular stock, a particular counter, if a crisis comes, and that's the situation that we talked about earlier, that stock can drop 50, 70, 60% in a couple of months. And once it hits that kind of level, it's very hard for it to be back to where you are or even higher. So I think it's very important that you have a sort of a diversified strategy over time to build wealth. It won't make you very rich in the next day or in a year's time. But if you keep at it, I think it can help you build your wealth over time. And the horizon is a long time because we have to plan to 100 years. So depending on how old you are, it's many, many business cycles. So it's very important to kind of not look at how I advocate is don't try to think about stock picking, don't try to think about timing the market. Have an asset allocation strategy that allows you to kind of grow your wealth over time and rebalance. The rebalancing would help in the sense that if markets does drop, stock markets does drop, if you set your rebalancing on a quarterly basis, typically you'll buy into the stock market as it goes down. So that would help you kind of build up equity position. But having said that, it will not give you astronomical returns in a particular year. Thanks for the question, Mike.
James, I actually want to ask for your thoughts on this because when people talk about hedging, a lot of times they talk about, they're thinking about using derivatives, options, warrants, DLCs even, things like that. And I think it may be useful for you to share some of your thoughts on using derivatives in your portfolio and what are some of the risks that come along with that?
Yeah, well, I think for a start, I think the main plan, what you should do is always to build that diversified portfolio first. And of course, that's step one, because most people doesn't even do step one. And I think that's the key thing. Hedging to me is a step, kind of a second or third step. And there are many, many ways to kind of hedge. The thing about most, for most regular investors, that there's just so much risk out there. You have geopolitical risk, you have lots of economical, financial market risk. And I think there are various instruments to help you hedge it. Even certain asset class can typically help you hedge it. I mean, dollar, for example, the US dollar, does provide some hedge when it comes to certain market risks. Gold is another asset class that provides some hedging when it comes to some of these geopolitical events or risk. But of course, there are various instruments. The easiest, of course, is some of the options. You could perhaps think of paying a little bit of premium to give you some downside protection. But I think if you have a diversified portfolio, I don't think you need to think a lot about hedging, because hedging does involve adding capital. It does involve paying. It also is a little bit more, I would say, and depends on which instrument. Some hedging instruments can be quite detrimental as well, because it requires you to take, there are certain ETFs that are inverse ETFs, for example, which it requires you to take an opposite direction. And I think these are the things, there are a lot of nuances with the characteristics of some of these instruments that could in fact lead to even more losses. So I don't advise regular investors to put on huge amounts of hedges, because in a way, once you put a hedge, you're taking a view. Just like market timing, security selection, to me, hedging is you're actually taking a strong view. And what I'm trying to advocate is, for most people, is just go for asset allocation. You don't need to take a strong view. And because taking a strong view requires you to, in fact, say that you are predicting the markets and you're smarter than the markets. and you have to be right. If you're wrong, you have to pay the cost. So that sometimes you might be lucky, sometimes you might not. But what's important is to have, to me, a diversification strategy that can be applied for everyone, which is more important.
Thanks very much, James. Time for one final question. Anyone? Yes.
My name is Anson from SMU.
Just grab the microphone so that make sure everybody can hear.
So just curious, wanted to hear your thoughts on, because BRICS are trying to dethrone the US dollar, right? So just want to hear your thoughts. Do you think that that would be possible in the near future?
Yeah, well, great question. I would say in terms of trade flows, you are seeing more and more kind of trading activity between some of these large economies, whether it's Russia selling oil to India, or even China buying certain resources within certain countries. And the currency of transaction need not be the dollar. So you are seeing some of that shift. But when it comes to a financial markets perspective, the bulk of reserve currency is still very much in dollars. Almost 60% still denominated in dollars. That means reserve managers still wants to use the dollar, really because of the breadth of what US dollar can provide. Whether it's the treasury market, whether it's financial derivatives, whether it's the equity market, the breadth is still very large. RMB, for example, is still about 3%, so it's a big difference. And if you look at financial centers like Singapore, Dubai, or even Geneva or New York, more than 90% of activity is still in US dollar. So for that switch out of US dollar, I think not very likely for the next 5 years. Maybe in future things might change, but at this point I think the US dollar is still the place to be in.
All right, thank you very much, James. All right, could we please give Mr. James Chiu one more big round of applause? Thank you very much. He'll be back later during the panel discussion because he will be able to answer any further questions you have. You can grab him during lunch also. Don't interrupt his eating. But he'll have some time during lunch to answer any other questions you might have. Now, next are created equal. Some are cheaper, some are more expensive, but which one is right for you? To help us answer that, and tell us about some of the instruments available to you, we're glad to have the chairman of the IMAS Human Capital Committee and also the CEO of Amundi South Asia. Please welcome Mr. Albert Tse.
Thank you, Edward. Hi, good afternoon, everyone. Similar to James, I'd like to ask some questions to get a feel of the crowd in front of me. How many of you are not 18 years old yet? Anyone? So all of you are actually qualified to drive a car if you want to pass your license, so you're above 18. Okay. Number two, how many of you are from NTU? Okay, so these were my younger classmates. So I was from NTU, so have some affiliation to you. So I graduated about 25 years ago. So coming here, seeing you, I feel very envious because 25 years ago, there wasn't seminars like this that I could have attended that could have helped me prevent some of my personal disaster in my early days of investment journey. Today, I have a clear mission. Number one, you heard what James said, the mantra, diversification, long-term, the power of compounding, and starting early. So I'm going to carry on that favor to help you convert your knowledge into actions. So there are three things that I would like to achieve today. Number one, for those of you who are 18 and above, you know what I mean. Before you drive the car, what do you need to do in Singapore? You need to pass your license. If any of you are not even courageous enough to start investing because you don't think you're ready yet, so I would like to recommend you to download these introductions to personal investing from MAS and IMAS. After reading it, it doesn't take more than a day. So simple. You are smart students. You would be ready to drive the car. Okay? So I'm here to deliver a gift for you. It doesn't cost money. Just download it. And later on, I have a few slides to introduce to you what this booklet is about. But the journey that I'm inviting you to join is not about ready to drive a car. I would like to invite you to be ready to even join Formula One. So some of you may have watched the Formula One recently. I don't. I'm not really a car enthusiastic. But I'm sure you know, to win the race of Formula One, is it about how fast you drive doing the one round? It's not, right? There were many rounds, I don't know, 20, 30, 50, and 70, or something along that line. So driving your car very fast does not lead to you leading at the pack and then win the race, isn't it? Just like what James has mentioned, investment in a way is not about how fast your V12, V8 or V6 engine is. It's really the whole journey, how you actually drive the journey again and again over a long period of time. So later on, I will also share with you what this speaker is trying to introduce to you. We actually have a game called Let's Invest Together. Later on, I will show to you. You can download the game from your phone, and you can have the luxury of past 20 years of data to be a fund manager on your own, with real data, real news that happens in the past that allow you to drive this car like a simulated, car games in the history, so that you know that you're ready to not just drive but also race also. Okay? And last but not least, we also have the third action point. Some of you are ready to invest. You pass your car license. You have done the simulation, or you have known the history well enough. You know what to do when interest rate is coming down. You know what to do when oil price is going up. You know what to do when there's a war. You know what to do when there's GDP recovery. So whatever James has mentioned to you, you're more or less, actually, I've learned a lot in school. I'm ready. Then the last part becomes very important. We have a fundsingapore.com. It's a website. You go in there. It's free. It gives you all the information that you need to build your car. What kind of tires you want, what kind of engine you need, what kind of brakes that you want, and the whole facade of the car as well, ready for a race. So these are the 3 action points. I don't think it takes more than a few months for you to be ready to join this race. Okay, so allow me to use the next 10-15 minutes to run through the slides, and I prefer to use my time to take your questions. All right? So let's talk about the beginning part. So a few things I'm going to repeat, similar to what James has mentioned, is what are the must-know when you start investing. I do not want you to get away from this seminar thinking that you can be a fund manager. You have to know what is the purpose of your investment. When I was in school and I started investing for myself, my objective is to tell myself I can be a fund manager. I can make 20% in 2 weeks. I do margins. So it's not investing. That's called speculation. So there's nothing wrong with speculation so long as you admit that this is speculation. This is not the purpose of today's workshop. Is there anything wrong with speculation? No, it's perfectly fine. I let my children have ice cream sometimes and candies. But investing is a serious business. So over here, you need to ask yourself this question. What is your end game? What is your objective? So in my case, when I invest, I have a clear objective that I need my child to go to a certain kind of school. I also need myself to retire with certain sum of money. And it's not something that I intend to speculate. I intend to invest. So that's the first question that you need to be very correct. Even if you know how to drive the car, even if you know how to drive the car correctly around the track of the Formula 1 50 times, if you get the end goal wrong, I'm sorry. It's still speculation. Number 2, from the booklet, you also share with you, you need to be cautious of expenses. You need to be cautious about costs as well. So as early investors, you enter into the market, you start investing, be aware about what are the expenses being involved. Sometimes when you look at an instrument on the website, on a certain system, you will see returns. But most of the time, these returns are before expenses, before fees, before charges. It's just like me buying a house. I need to know what is the monthly maintenance. I need to know how much I need to pay the agent, how much is my stamp duty, blah, 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 blah. So this is also a very important point for you to spend some time to understand the costs involved in different kind of instruments. Some instruments are cheaper on an ongoing basis, but they require you to put a lump sum higher amount at the beginning. Some doesn't really require you to put a lump sum at the beginning, but they actually charge you quite a fair bit during your investment journey. So do a bit of homework. It's not difficult. It can also be found in the booklet as well. And number 3, very similar to what James has already highlighted, risk return. There's no free lunch. I feel a bit amazed when sometime during Chinese New Year, my relatives ask me, Albert, are there any investment that guaranteed can make money? I said, wow. Are you talking about deposit? no, anything that can make 5-10% a year. I say, oh, there isn't. Then I say, but I heard that there's a guaranteed product. Oh, I say, guaranteed by who? So at the end of the day, risk and return is always there when you take a chance of your investment. If you really want a higher return, you need to accept that you need longer time horizon. You must also be willing to take the risk. So maybe the first thing you should do is to assess your risk first. But the fact that you are nearly 20, 25 years younger than me, your risk appetite definitely is higher than me. So you have the advantage of longer time to horizon. So to sum up, this is a very nice broker that was created in the past. While some of the information may be outdated, but trust me, if you have read this, within the day you can finish it. It's on the website, and you should be ready to drive the car. Okay? So just in case your current school is not preparing you for this, you have learned about economics, finance, everything, but when it comes to investing, you just feel that you're a little bit inadequate, don't worry. This booklet will be able to help you complete what is needed to drive this car. Now let's move on to the second step. You really want to be more ready than just able to drive a car to invest for your personal money. So I have the second segment. And just now, James has also highlighted this very important point. Imagine two speakers, we never speak to each other, we prepare our deck, and the messages are pretty similar. The importance of the power of compounding, and also the time that you need to let the money to grow for you is very, very important. So without looking into the slides, the numbers are on the screen. I try to put the red boxes in front of you so they can see clearer. If you put in 10,000 into an investment and it generates 5% a year, after 10 years, how much do you get? Oh, 5%, 10 years. So I should get back 15,000, right? No, the number is 16,300. The extra 1,300 is free from the compounding effect, if you allow me to use that word. So as you stretch the time horizon longer, after 20 years is 26,500. By right, it should only be 20,000. You stretch even longer to 40 years, your $10,000 can become 70,400 if you invest early. Another way of looking at it, there's a rule of 72. So if you generate a return of 6% a year, after 12 years, you double your money. So let me share with you my objective in my investment. In every investment that I enter into, it's about double or 3 times my capital. So imagine my time horizon. It's very long. And I can assure you, in our industry, it's extremely competitive. Not many managers, not now it's easier because interest rate is higher, right? For the past 10 years, dare to say, I can generate 5% per annum every year for the next 10 years. It's extremely difficult. So I'm just trying to say, the numbers that you see in front of you, just a 5%, for example, while it sounds very low to you, it's extremely difficult to achieve. But so long as you adopt the way that James just now highlighted to you, being diversified, not over-concentrated, understand the difference between risk and return and the relationship, then my job becomes easier later because I'm going to introduce to you how do you do it. So this is the part that I want to highlight once again. It's about the time in the market and not market timing. So this is the second gift that I have for you today. It's not from me. It came from Money Sense in collaboration with CPF Board and also with SGX. I came from IMAS. So our association collaborated together. We spent 18 months together to create this game for you. The genesis came from our genuine interest to get all of you to be ready to invest with information of the history. So while it doesn't help you analyze any information of the future, but it has all the historical data in the game so that when you play, while the game won't tell you this year is 2003, you won't do that. But the game will be in such a way that, there's a news in the market, central banks is hiking interest rate. Oh, there's a war happening in this country. Oh, there's data coming out from the China, GDP is rising, something like that. So you can play as a fund manager on the platform using real data that we have captured over the last 2 decades and see whether you are able to make money even with hindsight. Even with information that you roughly know, I remember last time when the situation like this, I should have done it this way. Then you can create your portfolio. You can have some cash, you can have some equities, you can have some bonds, you can have some commodities and alternative. And then you see and learn from your mistake also, because you don't get it right all the time. But from there, you can see how certain asset classes behave along the way when you see certain news in the market. So this is a good way for you to be more than ready to drive a car, right? It's like you enter into a simulation, a race, a machine, and then with the benefit of the past 20 years of data, you get yourself warm up before you actually have the real race. So you can download this game, it's free. It's called Let's Invest Together. For us, we call it LYT. And then the last part is about strategy. Now that you know you are ready to invest, what are the instruments available for you to actually apply when you actually invest itself? The speakers after me from SGX will be sharing with you some of the instruments. On my side, I'm going to focus more on mutual funds and ETF per se. So this is almost the same slide that James used just now. Before I'm trying to introduce you the concept of mutual fund or ETF, you need to understand why you need that in the first place. Number one is about the benefit of diversification. When you invest in equities, how diversified can you get if you only own one stock, let's say in Hong Kong? It doesn't represent the stock market, right? If let's say you want to invest in 5 stocks and you tell yourself, I'm going to diversify, and then I owe DBS, OCBC, UOB, Singpost, and SIA. Is it diversified? I guess you get the answer. So at the end of the day, what is true diversification? It's really about you trying to make sure you participate in the world economy and be as diversified by country and sector as possible. So this slide basically sharing with you for the last 15 years, the performance of the various asset classes and highlighting the best performing in blue and the worst performing in black. So the benefit is really about that.
Find your app. What's the app actually called? Can you repeat the app again?
Okay, so there's a question. It's okay, I will answer your question. Let's invest together.
Already technologies?
I can help you later on this download. It's actually from IMAS, correct? Yep. So allow me to speed up because I want to make sure I also take care of the Q&A later on. So this is the part about diversification by asset classes. So just like what James has also shared, it's very important that you keep a diversified approach. It doesn't mean that all the time you need to hold everything. You can change the weights from time to time, but it's very important you have a portfolio approach already very well illustrated by James just now. Now, you know that you want to be diversified by asset classes. Today, James, Albert mentioned about, oh, you need equities, you need stocks, you need real estates, but hey, hello, I only have 5,000. That's how I felt back then when I was like you. How can I be diversified? Then in this case, then appreciation of diversification by securities become very important. Because thanks to innovation, we created mutual funds and we created ETF to allow you to have easier access to a portfolio of securities. For example, if you want to own the 83 stocks that is in the MSCI world, you actually need around 7 million. But through unit trust or through ETF, you can use 1,000 and replicate the exposure that you would like. So this is the merits of having instruments like this, which is easily available in Singapore. And if you are looking at unit trust, which is actively managed, then the question that you will have is, which fund should I choose? So later on, I will show you another tool that we have created to allow you to find the most suitable tool. But the point I want to highlight here is that we make it available for you, accessible for you, so that you can be truly diversified by asset classes and also diversified by securities. And last but not least, I believe you already know the mathematical benefits of dollar cost averaging. If I may use one simple example, let's say I got $3,000 I want to invest over the next 1 year. There are 2 ways to do it. One, I invest in something that is $2 right now and hold on to it at the end of it. So imagine the green line here, you use the $3,000 to invest in the asset that is worth $2. And after this whole period, it's still at $2. So you didn't lose any or gain any, right? Because you invest 3,000 into $2, you get 1,500 units. It's worth the same at the end of the whole journey. How about dollar cost averaging? And you know very well, market don't move this way. Market is always like that. In the long run, you truly believe it's up. Okay, but it's always like this. So over here, it's just a very simple illustration. As you can see, as the market go up, you accumulate less. As the market go down, you accumulate more. And then at the end of it, you can see you accumulate 2,000 units. The difference of 1,005 and 2,000 units is the benefit of dollar cost averaging. It's free. So you remove your risk of timing the market wrongly. So this is the benefit of dollar cost averaging. So these are the 3 free lunches that we have for you today. And I will actually end by introducing to you the fundsingapore.com. I think it's a huge effort that LIA and also IMAS come together to create this platform with one purpose. We discover that youngsters really need information on hand. Do your analysis and choose your ETF and also funds to create your portfolio. When James just now mentioned about the diversification benefits, when I highlight the benefits of dollar cost averaging using ETF or funds, you may actually struggle, which one should I use? So we discover maybe through fundsingapore.com, we empower you with the information. You have access to 9,000 funds in the market. You can screen by performance. You can screen by Morningstar rating. You can screen by fund size. You can screen by region, asset classes. So this is a tool for you to do it on your own and navigate. And then you discover that, oh, it's not that difficult. Because I can easily find among the 9,500 funds, which are the 50 Asian equity funds that I want. And by the screening that the tool actually empower you, I know which are 2 or 3 or 4 of them that are pretty good in the long run. That's all you need to know. This tool also allows you to analyze the expenses behind the scenes. So with full transparency, by the click on the mobile, you can see, oh, this fund will cost you this much based on annual management fee and total expense ratio. So you make a conscious decision. Should you go into ETF, which is obviously much cheaper, but return may be different from active products? Or which you want to use active products that give you a slightly better return, potentially, but at a cost that is fully transparent to you. So this is what this tool is trying to achieve to help you to get into action when you invest into your diversified portfolio. So with that, I would like to just sum up before going to Q&A. I hope that I've guided you. For those of you who still feel yourself a little bit inadequate to be ready to drive the car, download the IMAS and MAS Introduction to Personal Banking, Personal Investing booklet. I assure you within a day, reading through the key messages, you should be ready to drive the car. For those of you who would like to go through the simulations and using the data that we prepare for you to create your portfolio and get your practice, you can go to Let's Invest Together, download the app and play the games. And I assure you that through the exercise, you also learn some of the relationship between some of the economic data and financial instruments as well. And last but not least, the implementation. What tires you use, which engine, which brake you want to do. We empower you with the information on fundsingapore.com, where you can choose your best component for equities, for fixed income, when you create your portfolios, as explained by James just now. So I hope that you will find this journey simple, easy. It's really not difficult. As I always tell my children as well, it's not difficult to be healthy. Eat well, sleep well, and exercise. That's it. When it comes to investing, it's as simple as it is today. So I finished my sharing. I would.
Please give a big hand to Mr. Albert Su. Thank you very much. So, any questions for Albert? He's covered a lot of really interesting, very important concepts and issues here. Any questions for him? We've got time for a few. Yeah.
Thank you. Sorry. So you teach us how to do investment. I would like to know what's the worst thing we can do when we invest money.
The question is, what's the worst thing that you can do with your money?
Yeah.
I think leveraging what James has already shared, you can sit. I think if you're over concentrated in putting your bets, if you create a portfolio that is too lopsided, and you try to time the market very hard, you're lining up for a perfect storm for yourself when the market condition is not very kind to you. So I think it's about doing what James has already mentioned just now. Then you don't have to worry about the worst case scenario, because if you have a portfolio approach, you're diversified, and even better, you have a dollar cost averaging strategy, I don't see the reason why your result will be too bad at the end of the day.
Yeah, but what Albert said is really important. Over the last couple of years, we saw bond investors, bonds are supposed to be very safe, very secure. But in the last couple of years, because the interest rates were hiked so fast by the US Fed, bond prices were destroyed. You saw that, right?
Yes.
Yeah, so it's really dangerous to put all your eggs in one basket. Don't just think, okay, I will just only do stocks, I will only do bonds.
Correct.
Or even worse, I will only buy commodities like gold. That can be very risky.
Maybe to echo this point Edward has mentioned, right? Just now, James and I used the same diagram actually. It's basically a table showing you calendar year return of various asset class. So of course, for us, if we are greedy, we want to predict which is the captain for the year. And then you asset allocate 100%, shift this. And I can assure you, no managers nor bank will even try to do it, because the truth is, it's so difficult. So the free lunch, let's talk about that. The free lunch is to make sure that you are diversified enough and you achieve the line in the middle of the diagram. So you accept that I don't enjoy the best asset class performance of say 20%, but I also avoided the disaster of losing 15% for that year. I achieve a more consistent return of say 5% per annum or 6% per annum by using a portfolio approach, dollar cost averaging, power of compounding, and let your time do the work in the long run. So that will actually come back to your question.
Yeah, very good advice. For those of you who are invested very heavily in equities, for example, in 2009 to 2020, those were the years when people looked at their broker accounts and wondered if they should continue investing again. I have friends who straight up told me, I'm never going to touch stocks again, I lost so much money. And that's a mistake, because they were over-concentrated in just one asset class. So thanks very much for that. Next question, anyone? Just raise your hand. Yes.
Hi, so I want to ask, is there any benefits to putting in mutual funds? Because usually they have much higher fees than ETFs and they are not actively managed. And then we can see based on the past returns that actively managed funds does not necessarily beat passively managed funds.
Thanks for the question. So, in fact, your burden is the same as our industry. When we created the fundsingapore.com, the genesis is this. Because we truly believe that a lot of the investors want to invest. They really master the courage, they really master the knowledge, and they're ready to invest. But when they invest in mutual funds, some of them were quite disappointed. How come the performance is not even beating the benchmark after fees, for example? So I think what you have done is very good, because you are discerning of the instrument that you're using to put into your portfolio. So may I suggest you that find good active products, combine with good passive products, and create your portfolio. Because it is possible to find very good active products in certain asset classes, and it is indeed extremely difficult to find certain products in the active space outperforming the passive. I'll give you an example. In Singapore, maybe there are about 50 to 60 US equity funds registered for you to buy. Maybe only 5 outperform the benchmark. So it's a very difficult benchmark to beat. So maybe you want to consider a passive approach. But if you twist the search to China, for example, or Asian equity, for example, maybe a third or even 40% of the managers are able to outperform the benchmark, not by marginal standard, but by a lot. So this is when you can make a conscious decision, this market is more inefficient, I can capture higher outperformance so long as I use the right managers, and through the search on the Fund Singapore, you can analyze whether they outperform the benchmark. So from there, you build your portfolio using good managers and also passive instruments. So that could be the way you want to consider.
Yeah, thanks for that, Albert. Could I see a show of hands, just out of curiosity? How many of you don't know what a unit trust or mutual fund is? Show of hands. Just be honest. Okay, good. Thank you very much. Thanks for that. So about a fifth of the room. So I think it's useful here. I ask Albert because he's the right person. He's been in asset management for 2 decades. So Albert, can you tell us a bit about what unit trusts, what mutual funds actually are?
Sure. So, if I may use a triangle to explain to you what mutual fund is. So imagine the 3 points I'm trying to illustrate. Very important, you must have a custodian of the assets. Let's start with that first. When you and all of us put money into the mutual funds or the unit trust, it's held with the custodian. This is not held by the manager. If one day we run away, you cannot touch the money still stay within the trust. That's why it's called mutual funds and unit trusts. The custodians are trusted. The legal structure empower the custodian to hold on to the assets so that you are always protected from fund managers who may have other ideas what to do with your money. The second party who is involved in the whole process is the fund manager, which is us. We are appointed to be the manager of the unit trust in the trust that I just explained to you, held by custodian. It's possible that, let's say, the fund managers like us will go bankrupt. Who is going to manage my money? There will be the overall trust owner to actually work with the custodian to appoint another managers to manage your money. This triangle is universal largely in every part of the world, but it's fundamentally the key difference between unit trust and other investment vehicles. Because in some other investment vehicles, you TT your money to them, they are the manager, they are the custodian, and they don't change themselves. So to me, this is fundamentally the most important starting point, because when you invest in the mutual funds, the fiduciary duty of the fund managers is to generate returns in the money held by custodian, watched by the trustee, who is making sure that the fund manager is doing the job every year. So to me, this is the biggest difference between a mutual fund versus other kind of investment vehicle. And also, just like ETF, mutual funds help you achieve diversification. You can have 50 stocks, 100 stocks, 1,000 bonds. So that would be the same. Yeah.
It can be quite extreme also, right? If you want to really be diversified, some of the biggest funds have thousands of stocks inside. Because really, if you really want to be diversified, then okay, we can push it to the limit. Or you can look for those who are looking for quality. They want a selection of the very best stocks in whatever field it is. Because let's be honest, how many of you know about Vietnamese stocks? Don't know, right? You invest in Vietnam, you don't know about Vietnamese stocks. Maybe it's a good idea to leave it to the professionals. They'll charge you a small fee every year, but they're the ones actually going. So the fund managers, you will actually go to the companies, right?
So I think the question alludes to what is the value add of the fund managers. So at the end of the day, our job is to outperform the benchmark. So the gentleman who asked this question is the universal question all investors expect fund managers to achieve. Please do not make me put money with you and then you underperform the benchmark. I would rather put my money with the passive managers. So in the case of Vietnam, which is obviously very inefficient, it's not difficult to beat the benchmark. So in order to do so, we need to put in resources, research analysts, portfolio managers, understand the market, know the company, and make sure that we're able to find the hidden gem and avoid those which are not fundamentally very good. And then we diversify the portfolio for you. So I think that is the cost that we're talking about embedded in the fund. If I may describe it simply for you, let's say you put $1,000 into a Vietnamese equity fund. The cost that you pay per year is probably $10 to $15 a year. So that will be the cost that you pay in your $1,000 in the fund that is commingled with other investors to the fund managers to do this job for you.
Yeah, and these professionals are the ones who are actually speaking to the companies, keeping an eye on all the news, literally visiting the business in some cases to actually see what they're doing, make sure that it's a solid, good investment for you. That's what you're paying for. One more time, folks, can we please give a big hand to Mr. Albert Tzu?
Thank you. Thank you, Albert.
So Albert will be back later for our panel discussion, but let me give you some quick spoilers for what's happening after lunch. At about 2 p.m., Mr. Alvin Chow, the CEO of Dr. Wealth, he's Dr. Wealth himself, he's going to be taking you step by step through how to invest in shares. So if you've never invested, a lot of you have never invested before, you don't want to miss out. That's happening at 2 p.m. Then we'll end the day with panel discussions where you get to ask all of them your burning questions. And I'm sure a lot of you will have some very interesting questions as well. If you don't want to wait, you can actually talk to them during lunchtime. Lunch will be served very soon. Before that, let me introduce you also to our facilitators. That not all investments. And in order to do that, some of us may feel that it's very daunting. Wow, what do I even do? How can I even start? What do I choose? Am I going to lose all my money when you do it? Okay, our next speaker is going to help you with that. This is his entire life's purpose, is to help you invest and feel secure and to feel educated while you're doing it. You may have seen his articles from his website, but you get to speak to him in person now. He's the CEO of Dr. Wealth. He's a trainer at the SGX Academy. Please welcome Mr. Alvin Chow.
Thank you. Okay, I'm taking the slot that is the most challenging because it's just after lunch. And I understand if you need to close your eyelids for a while, okay? Just go ahead. And my topic is a little bit different from the previous two speakers, is because they give you a very good overview of how you should structure your portfolio, right, on asset allocation and some of the philosophy of what you should do holding long-term diversifying, right? You will hear some of the parts that I will repeat here as well, just that I will focus a lot more on the individual stocks, okay? And of course, I also must warn you is that it is not easy, right? Just now, James already mentioned, security selection is not easy, okay? Most people would do fine with just an asset allocation strategy, right? But now we dive deeper into security selection. And I also want to give you an overview of like how the entire process takes. Then you will see for yourself whether this is your cup of tea. Because I know as beginner, you also don't know what to expect, right? Is it going to be 5 hours of work a day, or is it 1 hour of work a day on research is enough? So there is definitely effort and time. So I will bring you through that aspect. So let me set your expectation right first, okay? As I mentioned, it's more difficult than if you just do buy funds and you just do asset allocation. Security analysis takes a lot more effort. And it doesn't mean that the harder you work, the results become better. Sometimes if you just don't get it or you make a mistake, you can still end up with losses. And why is it so difficult? Because you're actually playing 3 roles. You are your own fund manager, because even if you pick individual securities, you still need to take care of allocation, without a doubt. How many stocks do you buy, right? And each stock, how much exposure do you buy? So the allocation decision has to be settled as well. And second, you're the analyst, right? In a fund, they have different roles. The fund manager is fund manager. The analyst will support the fund manager or the portfolio managers to suggest ideas to put inside the portfolio. But sorry, you're one person, one man show. So you have to go and dig for information, go and do your research, go and do your valuation all by yourself, right? Whereas in a fund, usually there is a full-time person or many full-time person looking at analysis, right? And then lastly, you're also a trader. Why? Because you need to execute your trade. So usually in a fund, they will just pass the order, and then there are the traders that will execute the orders for them. The analysts don't do it. They don't do the buy and sells, right? But you have to press the buy and sell button yourself. So you realize there's just so many things, so many functions and roles roll into one person. And that's why it takes a lot more knowledge, a lot more effort for you to do DIY investing. Okay, so that's the first expectation. Then, if there's so much things to do, why do you still want to do it? I can think of a few reasons, right? Different people may have different impetus. So first is that people feel that they are capable enough to generate higher returns if they do it themselves. Okay. Second is they just love the market. They like to be involved in the market. They like to read the financial news. They like to look at financial statements. I know it sounds a bit weird, right? Who wants to read financial statements as a hobby? Okay, but there are people like this. Okay, so there are people who are passionate about the markets. And then third, they just feel that they need to have more control in their investment decision, in the investment choices that they want to make. And lastly, it could be a life skill that they believe that even if I retire, this is something that I can pursue in my golden years and keep my mind active, right? And yet still can make money at the same time to supplement their retirement income. So there can be many different reasons for different people, but you definitely need a reason to do so if you want to do DIY investing. Setting other expectation, okay? You have to also understand that you cannot just go into the stock market and believe that the stock you choose is going to make you money. Sometimes you will still end up in losses. It is very easy, right? Okay, why I want to talk about this slide is because especially during the pandemic 2020, if you recall, some of you who have involved in the stock market, it was a pretty crazy time, right? The market was going up like nobody business. Okay, one day up 10% is possible, and then the next day you can go up another 5%. It looks so easy to make money, and during those times is where most beginners get sucked into the stock market, because who wants to go in when the market is boring, right, or going down? It's usually a bull market that attracts people in, and then after that the market will slaughter them. Okay, that's how cruel it is. And that's why I always want to emphasize that it's important to not just think of the upside, because naturally you think that the only reason why I invest is I want to make money, right? Why would I want to think about the possibility of me losing money? But you have to flip it around, right? Precisely that you want to avoid losses as much as you can. Think of the downside. If you can accept the downside, then the upside will take care of itself. Okay? Instead of get attracted by the upside, but you're not prepared for the downside. And when the downside happens, you get caught unprepared and you don't know what to do with your investment. And so that expectation is also very important. And the third thing is that losses are part and parcel of investing. I have never known an investor who have made 100% right calls. 100% make money. Every time they pick a stock, they make money. Okay? Even the best investor in the world, Warren Buffett, have lost money before. Recently, I came across this presentation that talked about 25 worst performing stocks in the last century. And I was surprised that Warren Buffett portfolio have 3 of them. And yet, he's still doing fine, right? He's still doing fantastically well. So just understand that no one investor can pick all correct stocks. And you have to accept losses will come. And will continue to come. Even Warren Buffett, who has invested for 80 years, 70, 80 years of his life, he still makes mistakes. Okay? But that doesn't mean that you should just anyhow invest, right? You should still do your due diligence, but understand that no matter how much work and effort you put in, as much as possible to avoid losses, you will bound to have them. Okay? So these are expectations that you need to have. All right? The next thing, now I'll give you the steps. So the very first step, if you really want to pick individual stocks or security selection, is that you need to have a strategy. You cannot base on your gut feel. Right? Oh, I think this stock is going to go up, that's why I buy. Or you watch some YouTube video and then you just buy that stock they talk about. Right? It should not be that. You must have a plan. What are the kind of characteristic that I'm looking for? What kind of strategy am I looking for? What kind of objective am I getting? So, for example, there are both intrinsic strategy and then as well as the extrinsic one. Okay, the intrinsic part is that within you must know what you're looking for, right? Objective. For example, you might be looking for dividend stocks because you are a retiree. Okay, not you guys now. Okay, maybe a retiree wants to look for dividend to supplement their income, and that's why they're buying all those high-yielding stocks. But maybe to you, you don't care about dividends. You care about growth. You care about more capital gains. Right? So your objective will cause you to invest in different kinds of stocks. Because just like humans, there are different kinds of stocks out there. Each serve its own purpose. Each a different life cycle. Second, risk tolerance. Some people can take a 10% drop. Some people can take a 50% drop. Still remain sane. Okay? So you have to determine how much volatility can you take. Right? You want exciting stocks, can you take a 90% drawdown? Okay? If you can, then you go for an exciting stock. If you cannot take a 90% drawdown, maybe you need to moderate a little bit on your selection. Third, personality. Some people are more impatient. They are more short-term driven. They like maybe momentum kind of trading strategy. Then some personality, they can be more slow and steady. They're more stable. They don't mind go for long-term investing. So all these factors will create that kind of mixture so that you can select a strategy that's suitable for yourself. Okay? So first, you have to understand yourself basically. Second is that when you try to learn about investing, there are so many strategies out there, even talking about security selection. Some people are growth investors, some people are dividend investors, some people are value investors, some people are momentum trader, right? Some people believe in quant, not so qualitative aspect. Some people believe AI is a better investor, right? So you have different philosophy, different school of thoughts. And it doesn't mean that anyone who says something online is your gospel truth. Okay, you need to filter and you need to decide what is best for yourself, right? A strategy that suits your intrinsic objective and values. So still at number 1, okay, so know what to look out for, right? This is just emphasis of the points just now, right? A growth investor, for example, will look at different characteristics of a stock, okay? So a growth investor will focus on like revenue, earnings growth, competitive advantage, or what Buffett called moats, assessing its future prospect. But to a value investor, all these factors are not important. Okay, a value investor will say, how cheap are you, right? Is your financial position strong? Okay, and then I don't need you to grow. Question is, how cheap can I buy you for, and how much can I sell you for later? Right? So you realize that different strategy will force you to focus on different aspects of the stock because there's so many things to look at. Okay? Just like if you choose a partner, right? Your friend's criteria to choose a partner may be different from yours. So you need to really know yourself. Second, you can't run away from allocation. Okay? Just now when we talk about James and Albert talk about allocation, they are talking more about asset allocation. That means how do you split between stocks, bonds, commodities, or other asset classes. But when you pick individual stock, there's also this concept of allocation because the allocation will drive your returns. Okay? So now I want to ask you this question, all right? Portfolio A has 5 stocks, equally weighted. Portfolio B have 20 stocks, equally weighted as well. Who believes that portfolio A needs more effort to monitor, or is it portfolio B that requires more effort? Okay, let's just do a survey. How many of you think A needs more effort? Okay, about 40%. How many of you think B needs more effort? Okay, the other half lah, half. All right. So if you answer B, generally you're thinking in the lines of because there are more stocks, that's why I need to do more work, right, to monitor them. Okay, but let's flip it around. Okay, if let's say portfolio A have 5 stocks, right, each stock has about 20% allocation, correct? Stock portfolio B, you have about 5% allocation in each stock, correct? Right? Let's say they both make a mistake. One of their stock go to 0. Who will suffer a bigger loss? A or B? A, right? So who has less tolerance for mistake? A or B? A, right? So who has to do more work? A, right? So the funny thing is that actually the fewer stocks you have, the more work you need to do because you cannot afford to be wrong. All right? That's why Albert and James talk about diversification because the more you have, each single security is going to have less impact to your overall returns. When you have fewer stocks, it's actually more risky. You cannot afford to be wrong. What if you 100% one stock? How about that? YouTube video a lot, right? Yeah, the most popular videos are usually ask you all in one stock. Okay, so must understand the risk behind. Okay, you cannot be wrong, right? Not that you cannot invest everything in one stock, lah. Okay, but you better make sure that you are very right, lah. Otherwise, you're gonna suffer big losses. And the next question is that then how many stocks is considered diversified, right? There are different studies out there. I won't go into the details, right? Unsystematic risk, systematic risk. Some of you who have studied finance, you will know that. But basically, different studies have find out different number of stocks would create enough diversification. Okay, some study quoted around 12 to 18 stocks. Some quoted 30 to 40 stocks. And some studies even go beyond 50 stocks. Okay, but you get a general idea. All right. So if based on that range is you should have more, okay, in order to reduce your risk, right? So the higher number is at 50, the lower number is at 12. All right. In order to diversify most of the unsystematic risk away, and that's it, right? It doesn't mean that all these 50 stocks in the same sector, okay? Because I also see a tendency that young investors, even though they have many stocks, they are all from the same sector, and they are usually in the tech sector. Correct? But if the tech sector down, all the stocks in the portfolio will be down. Okay? There is too strong correlation. So it's not really diversified. Usually diversification also infers that you will invest in different sectors and industries. All right? Number 3. Okay, after you buy your stocks, right, it's not the end. A lot of people think that, oh, long-term investing, right, just buy and then I chuck it there. All right? Okay? I give you an analogy, right? If you have a room and you don't maintain it, what would the room look like? Very messy, correct? Same thing. When you have an investment portfolio, if you don't maintain it, it will be messy. It will look like a mess. And that's why you need to monitor your portfolio. Okay? Not just when you buy your individual stock, even you do asset allocation, right? You buy stock, bonds, funds. You still need to monitor them. You still need to rebalance them, right? You'll get out of whack. Okay, and that's where you capture the capital gains. So same thing, individual stocks, you need to do even more work because every company may have different developments. And these are some of the corporate actions that if you want to pick your own stocks, you must understand what they mean. Bonus issue, rights issue, placement, splits, consolidation, a delisting offer, mandatory offer, right? So there can be many this kind of corporate action that will change the structure of the company, the prospect of the company that you need to understand and assess and judge whether this stock is still worthy to hold in your portfolio. Right, so you realize that it's really a lot more work. After you buy, it's not done yet. You still need to follow up with the development. And a lot of people, when they want to monitor their stocks, right, they will just, based on whether they read the news talking about their stocks. That is not a very good way to do it because the news selectively report certain stocks that are usually more popular or have big events happening. But you could be holding a stock that the news is not interested in reporting, and then you don't know what's going on. So it's very important that you follow the company announcements because every company, listed company, will have to make public announcements. Right? That's where you gather the developments of the company via all these announcements. Like for example, in SGX, they will have the announcement on SGX. And to make it convenient, you can actually use the SGX app. There's a notification button that anything happen to your stock, you receive announcement on your phone. So that also help you monitor your stocks easier. It's not like in the past, right? In the past, even share price, right? You need to use teletext. Okay, have you heard of teletext, by the way? Okay, never. That table, yes. That's why they are laughing. Okay, so now it's a lot easier already, right? But make use of the technology, make use of the tools like this, and it's free. The other aspect of monitoring your stocks is also you need to measure your returns. In fund management, right, they even have fund accountant. Every day just go and measure return only, okay, as a full-time job, all right? But if you do it yourself, you're going to do this, okay? Use Excel spreadsheet, understand what is time-weighted return, money-weighted return, CAGR, right? All these kind of things. Don't know? Then you can also use some of the websites that help you manage it better. Some they even pull stock prices so that you don't need to manually update. Okay, so that's some of the tools that you can make use of. But bottom line, you need to monitor. All right? Number 4, you need to know when to sell. Okay, I know a lot of people tend to hold their stocks, especially if they are having a loss. Okay? Who like to sell stocks at a loss? Nobody. We are all humans. Right? And the tendency is that it's not that we don't want to sell stocks. We only want to sell stocks when we make money. Agree? So you think about this, right? How would a portfolio look, right? If you always sell your winners and you always keep your losers, what does the portfolio look like? Red, right? It's all red, right? Agree or not? So actually, it's not that you have not picked any winners before. You have, but you sold them too early. But you kept the losses very, very long. Right? So it's almost like a garden. It's impossible not to have weeds. As I told you that you're bound to have losses, right? So losses are like weeds in a garden. As a gardener, you need to tend to them. You need to remove the weeds and let the flowers bloom. Okay? So flowers are like your profits. But what we do in portfolio is usually the reverse. The flower bloom a little bit, we cut. Right? Because take profit first, right? Then the weeds we keep. Then we hope that the weeds turn into flower if we hold long enough. Right? Sounds very stupid, right? We use that analogy. Okay? So you have to be very objective and you need to beat the loss aversion bias that James talked about just now. Not easy, huh? A lot of all these principles, I believe that you have heard of them before, but doing it is a whole different level. Okay? This is a statistic that I want to show you is that majority of the stocks won't do well in the long run. More than half of the stocks in the US cannot even beat the treasury bill return. More than half. So your chances of picking a dud is very high. Okay? Which means that you need to recognize your mistake as early as possible. That's the only remedy. Okay? Okay, because you can't foretell the future, which is a good stock and which is not. And time will tell you and give you a feedback loop. And that's where you need to act. If you keep holding on to your losses and your mistakes, right, you will drag down the whole portfolio. Okay, you need to be very ruthless in cutting your mistakes. Okay, this is something about loss aversion, which I will not repeat because James have already mentioned it just now, right? So we have some overlap. Huh? So loss aversion bias is basically saying that you treat your losses and your gains differently, right? Your losses is more impactful to you, and your gains are less impactful to you. Okay, the other bias is endowment effect. This happens also why you don't sell your losing stocks, because maybe you bought a stock at $5 and then now the stocks go to $2.50. You want to sell it because your price, you're anchored to that $5 and you think that your stock is worth $5. Why would you want to sell at $2.50? That's why you keep hanging on to your losses, right? Because you believe it's worth more than what the market is offering at this point in time. Okay, and it will go on, right? Because you're anchored to the price and you have this endowment effect that's in you. So when you come to investing, the problem is there are just too much biases for people to overcome. And that's actually the more tiring part than doing the research. Okay, is to really be honest with yourself and to take the right action despite all the biases acting against you. Okay, this is a question that I find it useful for me when reviewing my own portfolio, right? Whether to sell a stock, right? Especially if the stock has gone down. I always like to ask, right? Is this issue that they face, this company, right? Is the company issue that they face currently, is it temporarily? Or is it a permanent impact to the business? If it's temporary, then I will hold, right? If it's permanent, then I will sell it. Because there's no point holding on to it and hope that it will recover from there if it's going to be a permanent damage. Okay, so that is a useful thing you can ask, right? Rather than looking at whether you'll make money or lose money, okay? And 5, trade execution. This is roughly what I map out how the stock market work when you flow an order to the market through the brokers to the exchange, right? It's a very complicated mess. So which means if you do DIY investment, when you pick your own stocks, you also need to understand the whole ecosystem, how the mechanism work, CDP account, custodian account, all these kind of things, right? How it works, whether your funds are safe, is it segregated account, is it MAS licensed broker, right, that segregates your funds, all these kind of things. When you buy foreign markets, what are the taxation that you'll be applied upon? Dividend taxation as well, dividend handling fee, custodian fee. There's a lot of all this consideration that you also must know. All right. I'll just briefly go through. But what I'm trying to share with you is what the knowledge gap you might have. Okay, then you just go and fill it up and go and do more research yourself. And of course, you need to know how to read your bid-ask spread, your liquidity, your table, right? When you open a brokerage account, all the numbers flashing, wow, very exciting, right? Okay, so you must also know what is asked, what is bid. Now, some people go to the currency exchange counter also. Wow. So am I buying the we buy or are we buying the we sell, right? Very confusing, okay? So same thing, it looks something like this when you open up your brokerage account and then you have your prices flashing around. You need to know like how to place your order. And sometimes the liquidity may not be enough, right? You might want to buy a big order, but then you can't fulfill it. Okay, you have to settle it because there's no other trader that's going to settle it for you. Okay, you need to place the order, you need to structure your order. Sometimes the spread is big. Okay, so what do? How do you strategically place an order that can get filled without overpaying so much? All right? And there are many order types. Market order, limit order, stop limit order, one cancel the other order, right? So many order types. Depends on the broker that you use. They have advanced order types. Okay, so they may mean different things. And you need to use these orders properly in order for you to make certain trades or make certain expression of your ideas in the market. Okay. So in conclusion, is there a lot of things to do? Yes, right? Okay. Yeah, so I'm here to scare you so that you will not do stupid things, right? Okay. No, I'm not discouraging you, right? But I'm just showing you, I hope to give you the whole scope of things so that you know what is involved and then you can plug the gaps. Okay, and then so that you can do stock investing properly because it can be fun, right? And so it does have a lot of challenges and effort, and I believe that you do need some passion. Okay, otherwise reading financial statements is like a chore. Okay, yeah, reading financial news is like a chore, and the fact that you guys are here today means that you should have some interest. Otherwise, you'll be out there shopping or go watch a movie, right? Or stay at home and watch Netflix. But you all choose to be here, which means that you all have some interest. Okay, so you need to tap on that. And if you do, then learning about it can be quite enjoyable, right? But be patient because it takes time for you to learn this as a skill, just like anything, okay? Baking, cooking, right? All these are skills. It takes time to learn. You can't be a chef overnight. You can't be a good investor overnight. And to encourage you is that, as I said, it's already easier today compared to the past. There's a lot of free information out there. There's a lot of education events. There's like today, we spend the time with you. In the past, really, there's a lack of this kind of support for individual investor. So do make use of all this support that you can get. And as well as brokerage fees have come down significantly, right? Like now, I think $1-2 you can make a transaction. In the past, it cost $50 brokerage fee. So your capital size need to be a lot bigger to justify for that fee spend. Now, $1 or $2 you can make a trade. It's not that expensive anymore. And yes, more information, transparency, tools, and resources. So you just need to know where to look for them and make your journey a lot more enjoyable. Okay? So, I don't know whether I ended early or I took too much time.
Got time to ask you a couple of questions, but they need to set up also the chairs.
They set up.
We chat first while they're setting up.
Okay, sure.
Okay, you're set up. Any questions for Alvin? Anyone? The last thing he said, I remember the good old days, and it's still true for some brokers, I think, $25 each time you buy. $25 on the way in, $25 on the way out. You buy, $25. You sell, $25. They charge you $50+ just to buy and sell shares.
Yep. But now it's a lot more affordable.
Yeah.
Okay, but it might be a good thing because it stops people from trading too much.
So you don't anyhow buy and sell.
Yeah.
Okay, anyone? Questions for Alvin related to buying shares? Yes.
Sorry guys, me again. Okay, I have a general question. So will China and India will be good places to invest in the future, like China for 2 years, maybe 2 or 3 years after, and India maybe after 10 years?
Okay, your question is about investing in China and India. That's the time frame looking at, is it? As in China, is it 2 to 3 years? India? Okay. So James just now already showed you a very good chart, right? That the China equity market is very scary, okay? But that is essentially can be applicable to all emerging markets, right? They tend to be a lot more volatile. The reason is my point of view, right? It has got to do a lot with fund flows. The largest mutual funds, the largest hedge funds, the largest ETFs are all based in the US. Okay, and a lot of investments are US based, and US has always been seen as the safe haven. Right? If anything goes wrong, a lot of money flows back to the US. Right? And especially with interest rate that's higher, you always see this going back there. And that's why emerging market always have this boom and bust period. If the US money is more risk on, they want to take more risk, they flow to emerging market, then emerging market goes up. Then when there's trouble, they move money back and the emerging market crash. So I think this will be a perennial problem when it comes to emerging markets price movement. So if you really want to go into like China or India, you must be able to stomach really high volatility. Okay, and don't expect it to grow as nicely as what the US market offers. All right, it has a lot more stability in that sense because the money is stickier there. Rest of the world, the money gets capital flight once in a while, right? So I also agree with you that likely, if you talk about potential of economy being the biggest in the world, China is the closest. Right? Then after that, probably India. India is not there yet, probably 10 years behind in terms of a lot of things, right? Even language is not really synchronized in a certain sense. Bridge-poor gap still a lot wider, right? So I would think that even if the talk is about whether China is going to overtake US is another question, okay? So I think even the India topic can be a bit far. Right now, I think India is a bit hot. It's also because of the US narrative that they are trying to de-risk from China, right? So it's investing elsewhere. That's why you see Japan and India doing very well this year, right? So it's very narrative driven in the short term. I think structurally, economically, India is still far from it, China. All right.
Thanks, Alvin. Can you please give Mr. Alvin Shao a big round of applause? Alvin, take a seat, please.
Okay.
I'm going to invite James and Albert to join us also.
Let me pass them back. Can I pass you back? Yeah.
Please have a seat. And we're opening this up to all of you. So we have questions. You can ask questions to any of our panelists. You can ask all of them. You can ask individuals. That's perfectly fine also. But I guess I want to start by asking this really important question to the three gentlemen on my left. There's a wealth of knowledge. Okay, here there's over 70 years of finance experience sitting next to me. But when you first started, we start with James. When you first started, what was your biggest mistake on your investment journey?
When I first started investing, in fact, I graduated from finance, a finance degree. In fact, somehow I topped the class, and I became overconfident. I thought I know everything, and I had CFA some more. So I thought, okay, at least I'm invincible now. And lo and behold, when I started investing, I totally got hammered and killed. It's not that the knowledge that I had became a disadvantage because you thought that because you know, you can win it. But what you realize is that there's so much more to financial markets. There's an emotion component within me. There's also, markets are also driven a lot by the emotions of many people within the markets. And it's much more complicated. So that was something, a rude awakening for me. And that it's pretty tough. You've got to go in with a right strategy. And if you don't have a plan, basically you plan to fail.
James, very quickly, a chartered financial analyst, CFA. How hard is it to get that certification?
It's extremely difficult, at least for me. Because I think the model of the CFA essentially is to fail you. And they have 3 levels. They just want to fail you and fail as many people as possible. So they make it extremely hard for you. And that's to make it, they increase the prestige and difficulty just by doing that. So, I think usually they grade you on the bell curve. So that's how they do it. But I think for people who wants to start a career in the finance sector, especially when you're young, you have time to study, go for it. I think it gives you a chop of kind of a credential. Basically, it helps you with the knowledge, but also it shows that hey, you have the perseverance to survive through 3 rounds of extremely difficult exams.
Thanks for sharing that, James. So very sobering. He took one of the hardest certifications out there for finance professionals. He did well in it and still got hammered by the markets. So so keep that in mind, all right? That's how hard it is to beat the markets. Albert?
I think I'm of the same age as James. When I started investing, it was before the dot-com bubble. So back then, I didn't know someone like Alvin and James to tell me what is overconfidence or holding on to a money-losing position that would destroy your own portfolio. So back then, sounds familiar. Similar to James, I felt that I did well in school. I felt that I have all it takes. And I found a secret sauce to tenfold my capital back then in school. Haven't started working. It's called margin trading. So you suddenly realize that why am I studying so hard? So I lost almost everything thereafter. So I invested in something that I don't truly understand, even though I learned it in school. So I put all my investment into warrants, which is an excellent asset class, but if you do not know how to use it properly, it will bite you in the end. So that was my journey back then.
Same. I lost all my money in warrants also. We have a lot. We can share with you all, okay? Before you touch derivatives, have a clear idea of what you're getting into and remind yourself that I think over 95% of day traders lose money. Yeah, you're fundamentally at a disadvantage. Thanks for sharing that, Albert. Alvin?
I guess the theme is similar. It's all overconfidence. And I think this is a guy's problem. Guys always think that you are damn good, right? It's an ego thing. And especially when we are younger, we tend to not understand reality or appreciate reality that well. So we think we're up here, but actually we are here, right? So my same mistakes is overconfidence mistake as well. Also derivative related. Similar to warrants is the options. So I was selling options on natural gas. And I still remember it was a particularly cold winter, so the demand for natural gas went up. So I was shorting it by selling calls, call options on it. And it was a year there was a polar vortex in the US, so they're burning natural gas to keep them warm like crazy. Then I was sitting on losses. Then I went to sell further strike, right? Just to double my loss. Right? Because I believe that winter cannot last forever. Right? Eventually the demand for natural gas will come down. It is very logical, right? The winter did ended, but I didn't survive the winter long enough. The trade just blew up. And that trade alone, I lost $100,000. Right? So it was, and there was a margin call. I still need to top up. Right? Imagine that feeling. Okay? So it is really an overconfidence thing that, especially guys, you need to watch out.
But the good news is that they're sitting next to me and they're sitting in front of you and being brought here by MAS because they, in spite of these mistakes that they made, they learned from it, they grew from it, and they're able to come here and share it with you. So no matter how bad your losses are, keep in mind, you can always recover from it. It's just money. Okay, you can always make it back. Please don't ever think that you're a failure, that it's the end of the world. No, it's just money. You can always make it back. That's it. I'm sure you all have questions for our panelists. So anyone, just raise your hand. We'll bring a microphone to you. Over here, please.
Hello, I'm Brion. Hi, I'm Brion from NTU. Just like ask, these few weeks, the REIT sector, the S-REIT sector has been plummeting. So, any views about that? Thank you.
REITs. Anybody want to talk about REITs?
I can start first. Mainly it's an interest rate issue, right? Because REITs, they borrow money to buy properties, and they will perform inversely to interest rate. And the last few months, the trend is that the long-term bond rates, the long-term yields are going up, which also will increase the REITs borrowing going forward or lasting a longer period. So the market is discounting that future into today's prices, and that's why you see them falling.
But it seems like I think last week the Fed is saying that perhaps it's going to have the last hike end of this year, and after that is perhaps pretty stable or like cutting.
Nobody knows the future.
True.
But useful to ask, so thanks for that, Alvin. I'm going to open this up to Albert and James also. If the Fed doesn't stop hiking, if everyone's expecting them to do one and done, okay, but what if they do one, then it's two, and then three, and so on, and it's higher for longer? So what's that going to do to the REITs industry with heightened interest rates?
Yeah, I'll first take interest rate question, Federal Reserve. We have to kind of know that we are going to live in an environment where interest rates, or even essentially why interest rates go up so fast is to actually bring down inflation. And that's why we saw interest rates going up at historical highs last year to bring down inflation. Right now, interest rates in US 5.25%, inflation, core inflation about 4%. So there is a positive real interest rates of about 1+%. And that's essentially putting an economic brake on the economy. So it's slowing things down, which is good. And the good news is that inflation is starting to stabilize. But it's not likely that you're going to get inflation back to that 2% target that the Fed wants to. Because certain things have changed post-pandemic. Number one, jobs-wise, people are demanding higher wages. Primarily, I think because of this whole work-from-home environment. Certain jobs like in the service industry, healthcare, cannot work from home. New entrants into the jobs, the new job seekers asking for higher pay. So labor market shortage, one. Commodities also, likewise, because of the lack of investments into the commodity markets, there's no new mines that's being built out. And of course, with all these geopolitical wars and tensions, commodity price is still fairly elevated. So all these things are creating a certain increase in prices. that you can't bring back to that 2%. So as a result, interest rates are going to be high for some time. Might start to cut rates, the Fed might start to cut rate next year, but it will not bring interest rates back down to that zero that we were used to pre-pandemic. So we might live in a higher interest rate environment. But having said that, of course, the REITs market, it's highly correlated to interest rates because REITs on average give you 5 to 6% dividend yield. And of course, if you have the risk-free rate at 5.5%, people say, hey, why don't I put in cash, I put in bonds, why should I put in REITs? But having said that, interest rates are not going to stay at 5.5% forever. There will be a time that it goes down. And also, I would still think that you have to think of REITs as an avenue to kind of build income. Right now, it might not look that good. Hard to say 1 year down the road, 2 years down the road. Because in some ways, the REIT industry is made such that there is a debt ratio that the REITs can't raise debt more than 35% set out as the rules. They have to use their retained earnings. And also one of the important rules is basically, essentially, all these buildings are all REITs. Whatever income that they collect from all the rentals, 95% have to be paid out to investors. And it's very much like a trust. It's set up like a mutual fund in more ways than one. So there is a role for it. Right now, it doesn't look so good. But maybe 1 year down the road, 2 years down the road, it might look better. But nevertheless, I think learn more about it. It's a good income source. But of course, a lot of things depend on interest rates.
Thanks for that, James. Albert, anything to add?
No.
Okay, next question. Over there in the back, gentleman in black.
Oh, thank you. Okay. We can tell that the investment market, right, is not easy. Learn to investing. Then, like for me, I'm an engineering student. I don't have all the knowledge and technical knowledge on how business student, finance student they have. Is there any suggestion on what can we do as a non-business background? How do we survive in the investment market in the whole entire?
Well, you asked the right
journey,
people.
yeah.
Can I direct you to Mr. Alvin Chow, whose entire
actually,
life's purpose is to educate people like
Actually,
yourself?
I saw that he's a mechanical engineer in NTU, right?
Yes.
Yeah.
I studied mechanical engineering. I believe that investing is learnable. It doesn't mean that you need to go through a finance degree or for example, you want to interpret financial statement, right? You don't need to be a bachelor in accountancy. Right? You can learn how to read financial statements, but you do need to make up with a lot of self-discipline, and you will likely make more mistakes, right? And you have to accept that. You have to learn the harder way, basically, compared to someone with a background and the knowledge that is more applicable in this kind of situation. So you really must make up with a lot of passion and discipline. That's all I can say.
But also, the SGX Academy does try to help out with that, right?
As in, you must even take an effort to go and learn and attend classes or go and read more stuff, read more books. If you don't have interest in all this, then I think it's better to just buy funds would be a better option.
Albert?
Yes, I would like to encourage you to download the IMA's Introduction to Personal Investing. I assure you, maximum 2 days. You may even be able to finish reading within a day. It's really not difficult to drive a car. Investment is almost the same. I assure you, don't be surprised. Finance graduates may not do better than engineering either. So we all make mistakes. So take the step to get yourself to be familiarized. If you want to know how you would have performed in the past, then you can download the Let's Invest Together game, LIT, and that's when you start to learn, in the past, this is how investment behave in different market environments. So that will warm you up to have the confidence and know how to react in the future. Lastly, I strongly encourage you to maybe eventually find a good advisor, because the advisor can help you bridge that gap of knowledge and help you take the first step of starting to invest regularly.
Yeah.
If I may add on, right, because if you're an engineering background, usually you are stronger in numbers. And one way is that you can always start with something that's more quantitative when it comes to approach to investing, a lot more data-driven, right? That can be a way to start instead of trying to try different methods, because it plays to your strength.
The worst way to learn is try and error. So they spent hundreds of hours putting these things together painstakingly for you. Please learn from them and their hard work. Check out the IMAS resources and also check out Alvin's website, Dr. Wealth. Yeah, so it's very, very helpful. Literally, there's a whole pile of resources out there for you. So much easier today than compared to the good old days of teletext when people were actually shouting at each other in a pit in order to trade. Okay, literally, people shout at each other to trade stocks at the stock market. Okay, next question.
Hi, I'm Stella from NTU. I would like to ask the panelists, what are the sector that you think that in this current market condition that is good to invest in?
James, you want to take this one?
Yeah, well, I don't want to kind of put any focus on any sectors, although we all got views. I would always say start from having a kind of a diversified portfolio at the start. As a location, it's extremely important. But even before that, I think as students, you all have to solve the basic stuff first. Because to me, sector is like you must pass a lot of things to reach this part. And I think the basic things as student, I think first up, it's how do you first, even when you start to work, how do you secure, how much should you save? How do you optimize CPF? How do I use whatever I save to plan for my HDB purchase? That sort of thing. And then whatever excess, I'm going to invest. And how am I going to invest to reach those goals that I set out? So I think set those things in place. Then after that, we talk about which sectors, because no point. Because as I've shown that stock, right, sometimes 20 years ago, Nokia is the darling, right? Now, of course, the tech stocks, all of them are the darlings. 10 years down the road, no one can guarantee anything.
Can you diversify within the sectors or across sectors in that sense?
I think so, you can. Of course, there are various ways to do it. If you buy on an individual level, it's very, very troublesome. So things like mutual funds, ETFs, these are ways to help you get broad access.
Can I take a quick poll? Anybody don't know what ETF is? Be honest, raise your hand. Don't know what ETF is? 1, 2. Anybody else? Not sure. Okay. Well, worth, Albert, I'll ask you again. Okay, worth talking about. What is an exchange traded fund? We talk about the indexes first, the biggest ETFs.
I guess in the investing world, there are two buckets, active and passive. Both have merits. So I do not want to go into a debate which is better. I think for young investors like myself 25 years ago or like you may not have the kind of time or energy to go and discover the hidden gem in the active fund universe. ETF is really the most straightforward, cost-efficient way to start building your portfolio, like how James just now mentioned. So you can easily access all these global equity, global bond, or regional or sectoral ETF on many platforms that you can find in Singapore. What is ETF? Basically, it's a vehicle created to actually invest in a portfolio of stocks, mimicking, following, tracking a particular index that represents a market. For example, S&P 500. For example, FTSE STI, for example, Hang Seng Index, for instance. So it's a vehicle for you to assess the stock market. It doesn't give you alpha or outperformance or underperformance, but it does the tracking for you, and it's supposed to be very cost efficient. Yeah.
Thanks for that, because you own self go and buy 500 stocks. Good luck to you. Okay, why not just buy the ETF? So that's an option. All right, and it's also very cheap because you can buy it for very, very small amounts rather than needing to spend a large lump sum on it. Okay, next question. We've got time for, I think, 2 or 3 more questions before we wrap up for today. Anybody? Actually, I think it's worth it at this point of time to chat with our panelists also, because listening to what you all have been saying, listening to some of the responses from them, James brought out a really good point, which is what do you do before you even think about investing? right? You want to think about investing, yes, but what about all these other things? Insurance, making sure that you've got your financial goals covered. You're going to get married soon. You need to cover your savings. Making sure you're taking care of your expenses. You're not overspending. You've got debt. If you've got credit card debt, why are you investing? Things like that. And anything you all want to share about that, Alvin, maybe?
Definitely, there are a lot more life milestones that young people need to go through, right? Saving for the house, marriage, splendid wedding, wedding ring, cars, endless, right? So it definitely pays to work out all these numbers and budget properly. And just now we were just doing a video recording, and one of the questions is that do you invest or do you buy insurance first? Right? I think that was a question along that line. I do think that insurance is about transferring risk. If there's certain risk that you cannot accept, if it happens to you, you better transfer it away. For example, a hospitalization bill, right? Outsized hospitalization bill. That's what you want to diversify the risk away, you buy a hospitalization plan. So I do think that there are some of these personal finance matters that need to be handled. But I also believe that investing, if you don't prioritize it right, you will always delay it to a later time. So my personal experience is that how I started out was to commit to a monthly investment plan, or this concept called pay yourself first. When you get the salary, right, you pay yourself instead of paying the bills to everybody else, and you leave whatever is left behind for yourself. So what I did was that, because initially when I first started out, I was a spendthrift, I wasn't a saver, and that was a forced saving for me, but at the same time I invest. So every month, you just deduct a few $100 from my account. The moment I take my salary, they get deducted. So I can't do anything about it. And then it just get put to work in the markets. So I do think that it's a balancing act. If you are in a certain situation that you need to make yourself commit to a particular plan, I think a money investment plan is always a very good one.
Can I ask, show of hands, okay? How many of you think it's reasonable that you can invest $500 a month? 500, bit too much, okay. One hand. No income, okay. I lower the amount, okay? $250 a month. Few more hands. Okay, baseline. $100 a month. How many of you think you can do that? Okay, we've got about 10% of the room. $100 a month, we divide that by 30 days. How much is that each day? $3.30? Can you save $3.30 a day? If you can do that, you can invest $100 a month, right? That's $1,200 a year already. And that very quickly all adds up. I want to add to what Alvin said, because if you pay yourself first, a regular savings plans, the cheapest one is $100. RSP. You can buy stocks for $100 at a very low fee. So think about that. You can do it through your internet banking app. Okay, that's how easy it is. Okay, you can get started for just $100 a month. That's $330 a day. And this is not insurance. This is literally buying stocks. Okay, keep that in mind. Any other questions? Anyone? Yes.
I currently am a year 1 student, so I was thinking, how can students take the first step to invest? Is it advisable that we buy some financial products and we talk to some financial consultants?
That's a great question. Thank you very much for that. How should they get started?
I can answer half of your questions. So the fact that you asked this question, you are halfway there. So question, what do you need to do? So as I mentioned in the presentation, you need to know how to get the license to drive your car, remember? So you can read the booklet which I refer you, or any other sources which many financial institutions are also trying to help you. It really doesn't take long. Even if you do not have a finance degree or you're not in a finance course, it is really easy, get through it. Number 2, you asked about how do you start. I think the key is to know how to keep it simple, like how James and I make it to you. Just keep a portfolio, regular savings plan, and keep it simple, and don't try to predict the world because it's so difficult. Then start small and then see how it goes over the next few years. Don't be surprised, your learning journey will tell you the answer eventually, how to do it better over time. So that's from me.
Yeah, thanks for that, Albert. Do you have any follow-ups for that? Are you happy with that?
So how about what can financial consultants help us, or will it be more advisable if we listen more completely to what our consultants say? Or do we just base on what our read and our research?
So DIY versus going to a finance professional. I asked James that. James, this is your rice bowl.
I would say before you start investing, invest in yourself. Or such that you can ask right questions. I think that's very important. First, you have to ask, what do you want to achieve? How much can I save? How much can I lose? What do I want to achieve at the end of the day? And if you can ask yourself these questions, you do your own research. And of course, if you have professionals that come along the way, ask them those questions also, such that you have to first know that when you seek advice, depending who, that there always has a certain sales element involved. Know that for sure. Can't get away. So know those numbers, know those fees, ask those right questions, and they could be a partner for you. But if they can answer those questions alongside you and work out a plan together, I think that helps.
Thanks for asking that. And remember, like they said in their presentations, if it's making you uncomfortable at night, you can't sleep, you probably invested too much.
And I can add is that because the information is around, you can always search online, read some reviews. You can also talk to more than one advisor. You don't need to just stick to one and take it as that's the truth, then you should just follow. Basically, get different viewpoints and you make your own assessment, which is the best way for you.
Yeah, thanks for asking that question. All right, we got time for 2 more questions. Mike.
Hi, Michael from SUSS. There are something called funded accounts. So we pay them maybe $100 for a $25,000 account, and they will qualify you before they even accept your $100. So this style of funded account actually will tell you you're not ready for the market. They will disqualify you before you even try to come into the market. So with this type of knowledge in hand, is there anything like that in Singapore that we can approach? At least we can gauge ourselves.
Is it like a hedge fund?
No, funded account.
Funded account. Yeah, but
I'm sorry, I don't understand what you describe, but it sounds like something I would not put my money inside.
yeah.
Okay, yeah, this thing exists in the US and in the UK, maybe not in Singapore. That's why I bring it up, because we're talking about Singapore as a Singapore investor. But as an investor to come into any market, you are up against the whole market, when yourself is not that qualified. But with a funded account, they actually qualify you because you're going to trade with their money. So when you do that, you actually know that you're ready for the market. So before any one of us approach the market, how do we gauge that we are ready for it? So if I were in the US or UK, I can take that approach. But not in Singapore. I don't have that approach to actually know that I'm ready for the market. And then as we all know, 90% of us is going to lose money when we come into the market.
Not that 90% of us will lose money. I think 90% if you day trade. If you're doing short-term day trading, there's a high risk. But thank you for your question. I think it is a fair thing to end today's session with. I'm going to ask all 3 of you, starting with James. How do you know when you're ready to start investing and put your hard-earned money into the markets?
My personal view is this. I share there's 3 components to making money in financial markets. One is security selection, timing the market, and the third is asset allocation. And in fact, in the bank, we have lots of an army of security analysts trying to pick the stocks. We have people trying to time the market through lots of different charts. And I'm the one allocating assets. In order for you to beat market, you have to first beat us, the bank. Very hard for... I'm not saying that we are right. We make mistakes also. But we make mistakes with our eyes open, watching it 24 hours, reading lots of stuff, and it's an army of people, not one person. So for one person to try to beat us, in order to make money, you have to beat us at least minimum, consistently. it's not easy for an individual. That's why I say forget about security. Don't fight the market. Do the asset allocation. Put a savings plan, dollar cost average. Everyone can survive that. But if you want to pick the right stock, pick the right sectors at the right time, chances are more often than not you will lose. If you make, probably lucky.
Words of wisdom. Thank you very much for that, James. Albert?
Yeah, I think I'm ashamed to say that when I put so much effort to manage my own money, it significantly underperformed my children's portfolio, where I did nothing. Every month, just put $100, $200 for each of them. And I did that since 5-10 years ago, investing into something very simple. And actually that outperformed my very own complicated portfolio. So I'm not qualified to actually give guidance to this friend here. But I've learned in a hard way, sometimes keep it simple. Investment actually could be very easy, so long as I think James have said something I shared fully. Have a diversified approach, dollar cost averaging, let the money work hard for you. Then you discover that actually our time can be used for our loved ones, can be used for holidays, can be used for other purposes instead of the money that we earn, which we spend so much time in the office already. So that's my input.
Something's really priceless, right?
Yeah.
More important than money. Thank you very much for that. Final word from you, Alvin.
I believe no one will always be ready for the markets because it's a continuous learning journey. And does it mean that you take some exam, you pass, like for example, you completed CFA, you are ready for the market? Don't know, right? If you started investing your first dollar, are you ready? We also don't know, right? So I think essentially you have to find your way. There's no textbook way for everybody. Unfortunately, there's no 10-year series, right? Students are very used to it. There's a template we just follow, and then we get the outcome. Unfortunately, the world of investment is a lot more complex, but I concur with what both of them shared. Simplicity is everything that is everybody can do it. Right? It's only when we start to make things more complicated, there's where more skill and also a dose of luck that's involved in order for you to do well. And luck is something that you cannot control. Right? Sometimes you can be skillful, but the timing is just wrong. You also get hammered that way. So it's very hard to answer the question, are you ready? I don't know. Yeah. So, but I do believe that you have to start somewhere.
Thanks for that, Alvin. Can we please give a big hand to our three speakers, James, Albert, and Alvin? And thank you to all of you for joining us here today. We have been here because this event was organized by MoneySense together with the Association of Banks in Singapore. Thank you to all of you for spending your weekend with us, and we wish you all the best for your studies and on your investment journey. Bye, everyone. Oh yes, please scan the QR code to submit your feedback. Tell us what you liked about today. Tell us what we could do better so that we can make better events for you in future. Thank you very much.
Thank you. Thank you.
Something so pleasant about that place. Even your emotions moving, so much space. When you're out there without them, and you're sure that it takes, and it wasn't because I didn't know. I just need to know. Does that make me crazy?